Welcome to our analysis of Alibaba Group's September quarter 2025 results. We're going to unpack the huge tension at the heart of their strategy.
It's a fascinating report. You've got this really strong underlying revenue growth.
Yeah.
We're talking 15% like for like.
Right.
And that's all driven by their big bets. AI, cloud, and getting people to buy more faster. But that comes at a huge cost.
A huge cost, a massive hit to profit and their cash flow. It's a real trade-off.
Exactly. They're funding the future very aggressively.
So let's dig into that. Let's start with the core numbers for the quarter ending September 30th. Total reported revenue was around 248 billion RMB.
Yep.
Which, on the surface looks like a pretty slow 5% year-over-year increase, but like you said, that's not the real story, is it?
No, not at all. That
Yeah.
5% is it's really misleading. It completely masks what's actually going on.
How so?
Well, that number includes businesses they've sold off, like SunArt and InTime. If you strip those out and just look at the businesses they're actually still running.
The core operations.
The core operations, yeah. They actually delivered a really robust 15% year-over-year growth. That tells you demand for what they're actually focused on is very, very strong.
Okay, so demand is strong, but the profit margins got absolutely crushed. I mean, income from operations fell a staggering 85% year-over-year.
85%. It's a huge number.
And their adjusted EBITDA, which is, basically their operational profit measure, that fell nearly 80%. I mean, for a company this big, that's a tough pill to swallow.
It is, but from management's perspective, this wasn't a mistake. This was a choice.
A conscious decision to burn cash.
Unequivocally, this wasn't inefficiency. They were very clear. They said, look, we are pouring capital into quick commerce, into the user experience, and into just heavy, heavy tech infrastructure.
And you really, really see that in their cash flow. I mean, it's brutal. Last year, cash was pouring in. This quarter, their free cash flow was a negative number, an outflow of almost 22 billion RMB.
Over $3 billion US.
It's just an astronomical shift in liquidity.
And that 22 billion RMB outflow, I mean, that perfectly sums up their entire strategy right now. They're spending it on two things.
Okay.
One, building out the entire AI and cloud infrastructure they need to lead the market. And two, funding the logistics and all the costs needed to scale up quick commerce. They're choosing the land grab over the dividend check.
So let's follow the money then. If they're sacrificing profit, where is it paying off? I think that brings us to the Cloud Intelligence Group, which was, well, frankly, the star of this show.
Oh, absolutely. It blew past expectations.
The cloud segment revenue grew 34% year-over-year. That's almost 40 billion RMB.
And what's even more important for investors, I think, is that revenue from external customers, so not other Alibaba businesses, that also shot up. It grew by 29%.
So they're not just selling to themselves, they're actually winning in the open market.
Exactly. They're gaining real market share.
And the engine behind all of this seems to be AI. I saw that AI-related product revenue had triple-digit growth for the 9th quarter in a row.
9th consecutive quarter. It's a remarkable run.
And it now accounts for over 20% of their external cloud revenue. That feels like a real tipping point, It's moving from just a niche product to a core part of the business.
And what's really impressive is that they're doing it profitably.
Mm-hmm.
This isn't just growth for growth's sake. The cloud group's operational profit, the adjusted EBITDA, was up 35%.
So they're dominating the market and improving margins at the same time. That's rare in this kind of tech arms race.
It is. They have the biggest slice of China's AI cloud market, about 35.8%, which is, more than their closest competitors combined.
So why are they winning? Is it just about having the deepest pockets to buy all the hardware, or is there something else locking customers in?
It's the second one. They're building a real competitive moat with what they call full-stack AI.
Full-stack AI. What does that mean in simple terms?
Well, most cloud companies just rent you the servers, the infrastructure. Alibaba is providing everything from the high-performance hardware right up to their own foundation models, like Qwen.
So it's not just renting an empty room, it's renting a fully equipped workshop.
That's a perfect analogy. And that creates this powerful ecosystem effect. For example, you have developers on platforms like Hugging Face who have already built over 180,000 new models based on Alibaba's Qwen models.
Wow.
If you're one of those developers, the idea of switching to a rival cloud, it becomes a massive headache. That's how they lock in that market leadership.
Okay, that makes sense. A clear, profitable strategy for cloud and AI. So now let's pivot to the other side of the coin, the part that's eating all the profit quick commerce.
Right. This is the definition of a strategic cash burn.
The revenue numbers are huge. It surged 60% year over year to almost 23 billion RMB. And this is all from their Taobao instant commerce initiative.
Yeah, and the core idea here is pretty simple. It's an acquisition and retention play. It gets more people using the Taobao app more
It
often.
makes the app stickier.
Exactly. And that helps their traditional e-commerce business too. People spend more, they come back more often, it keeps them in the ecosystem.
But that stickiness came at a brutal cost. The entire China e-commerce group's adjusted EBITDA just plummeted by 76%. And you're saying quick commerce was the single biggest reason for that.
It was the #1 driver of that margin compression. But, and this is the crucial part for the future, they're getting way better at the unit economics, the UE.
Unit economics, so just to be clear for everyone, that's basically the profit or loss on every single order, right?
Precisely. The revenue from one order versus the total cost to get that one order into the customer's hands, delivery, packaging, all of it.
So where are they finding the savings?
Management said they've made huge improvements since September. It's mainly two things. They're getting much more efficient with logistics, so cheaper and faster delivery, and the average order value is going up.
People are buying more stuff each time.
Right. They're either buying more expensive things or just bundling more items into one order.
And did they put a number on that improvement? What's the result on the bottom line?
They did. They said they've cut the per order loss by 50% compared to where it was at its peak back in July and August.
50%. That's a huge improvement in just a couple of months.
It's very significant. It shows the model is, it's starting to work. It's becoming financially viable much faster than a lot of people expected.
And that's key because their goal here is massive. They're aiming for quick commerce to hit 1 trillion RMB in gross merchandise value within 3 years.
It's a huge target. It shows this isn't just a feature. It's a core pillar of their entire future strategy. You take the pain now to secure that massive scale later.
Let's talk about that future investment then, especially in the AI infrastructure. They've already spent, 120 billion RMB on AI and cloud CapEx in the last year alone?
And that's just the start. The CEO, Eddie Wu, he basically said that their initial 3-year spending target of 380 billion RMB it might be on the small side.
On the small side, so they might spend even more.
He indicated that if demand stays this strong, they might further scale up that CapEx investment. They're trying to build a capacity advantage that no one else can match.
Which brings up the big question, right? Is there a risk of an AI bubble? Are they just building all this capacity that might sit empty in a year or two?
Well, according to them, the answer is a hard no. Their view is that AI computing resources will actually be structurally undersupplied for the next 2 or 3 years.
So demand will keep outstripping supply.
That's the bet. They pointed out that even older GPUs, the chips you need for AI, are running at full capacity all over the world. The bottleneck isn't demand, it's the physical supply of hardware.
So this is a race to secure scarce resources.
Exactly. Now, on the outlook, they do expect profitability to keep fluctuating because competition is still fierce. But the really intense cash burn from quick commerce, that should ease up a lot next quarter because of those efficiencies we talked about. September was likely the peak of that spending.
And before we wrap this up, just a quick note on share buybacks. They're still returning capital to shareholders, right?
They are. They bought back about $253 million worth of shares this quarter, and they still have a huge authorization left, about $19.1 billion they can use for buybacks through March 2027.
So they're walking and chewing gum, investing aggressively while also supporting the stock.
That's the strategy.
Okay, so this whole report is just a masterclass in strategic commitment, really. We've got these two very different stories playing out.
I think it really boils down to two key takeaways. First, the cloud and AI business is delivering that profitable, accelerating growth. It's working. And second, quick commerce is successfully buying scale, and while it's costly, the underlying economics are improving really, really fast.
So they're trading today's profit for tomorrow's market share.
That's the entire game.
And the final fundamental choice here is to sacrifice an enormous amount of cash, that nearly 22 billion RMB outflow, to build what could be near monopolistic positions in AI compute and on-demand delivery.
Which brings us to the final thought for you to consider. Alibaba is sitting on a massive war chest. They have almost 574 billion RMB in liquid investments. Given that, what is the true cost of market leadership when you have the capital to sustain this kind of spending for years and your competitors might not? That is the high-stakes game they're playing right now.